Accounting Adjustments Problem 6. On November 1st, Year 2, Jalapeno Company paid Habanero Rentals $37,000 for a 12-month lease. Record the deferral and related 12/31 Year 2 adjustment for both companies using their accounting equations. This is a great problem because it deals with adjustments and it shows you how a specific adjustment on one side can be an opposite adjustment to the other. Now, there's a few little hints here. Record the deferral and related 12/31 Year 2 adjustment for both companies using their accounting equations. We know that when it comes to adjustments, there's four main adjustments. There's prepaid expenses, unearned revenues, and accrued expenses. Because it's dealing with deferrals, we really know it can only deal with prepaid expenses and unearned revenues. I'll tell you that in this problem, it deals with both. So what we're going to do is we're going to use the accounting equation, and we're going to go through both of these specific questions. First, we're going to start with Jalapeno Company. So for Jalapeno Company, I'm just going to use the yellow. Let's go through. In terms of our accounting equation, so put up here, Jalapeno assets equals liability plus equity. It's a company, so we can assume stockholders' equity. So the asset accounts we're going to have here, cash and the prepaid rent accounts. Those are the two specific ones. No liabilities. And then for equity, we're going to have common stock and retained earnings. So Jalapeno paid Habanero Rentals $37,000 for a 12-month lease. That was on November 1st, Year 2. Let's go ahead and record that transaction, the paying of the 12 months for rent. That cost Jalapeno $37,000 cash. Let's go ahead, put that. And then we record a $37,000 prepaid rent. And our accounting equation balances. Now, we're told record the deferral. So that's the deferral entry. The use is the second entry. So the idea here, we'll put this on the side. Jalapeno is purchasing on November 1st, Year 2, a 12-month lease, prepaying a 12-month lease. So that's going to go through 11/1 Year 2 through 10/31 Year 3. We're just asked about Year 2 in this question. So the related 12/31 Year 2 adjustment, we go November of Year 2 and December of Year 2, then it switches over to Year 3. So we're just going to adjust for 2 months, 2 over 12 months. So what we do is we take 2 over 12 and we multiply that by $37,000 for the total 12 months, and we get $6,167. That's the amount that's attributable to the 2 months. So that deferral, that adjustment, we're going to reduce the rent down by $6,167 because remember, when you purchase a prepaid, that's an asset. A prepaid is an asset. However, assets, specifically prepaids, turn into expenses. In the future, they become used. So we're recording on 12/31 the use of November and December, 2 months of the prepaid. Then on the equity side, no effect to common stock, but retained earnings, we're going to have a decrease in retained earnings of $6,167 because we're going to record rent expense. We're going to record an expense for $6,167. So that is how we're going to write that. $6,167, it's an expense. That's Jalapeno's side. That's Jalapeno's side of the equation. Habanero is going to be easy. We're going to do the accounting equation again. That's what the question is asking us. Again, we do assets equals liabilities plus equity. So what assets are involved here? We have cash, the cash account. What liabilities? So we have unearned revenue. If you think about it, remember we have two types of deferrals. We have prepaid expenses. That's what Jalapeno did, purchased prepaid rent. And then we have unearned revenue on the other side. And I'll explain more in a moment. For equity, we have common stock because we're assuming they're corporations. And then we have the retained earnings specific accounts. The idea here is Jalapeno is purchasing from Habanero Rental the right to lease property for 1 year. When Habanero sells that, because they're basically selling this in advance, the 12 months have not yet occurred. They are receiving $37,000, but they have yet to perform the services. That is considered an unearned revenue, which is a liability. So at the time of the record of the deferral, when the deferral is recorded, Habanero receives $37,000 cash, and then also records a liability, unearned revenue of $37,000. Now, when 12/31 year 2 rolls around, when 2 months worth has been extinguished, does cash change? No. That's the actual adjustment that takes place. The unearned revenue is reduced by 2 months because 2 months has been performed. November year 2 and December year 2. And we're doing this for December 31st year 2. We're doing the adjustment. So 2 months worth of the 12 months worth of the $37,000 12 month 1 year lease has now been fulfilled. So 2 months. 2 months over 12 months times $37,000. We've already done this, is $61.67. So we're going to reduce unearned revenue by $6,167. Common stock is 0. Retained earnings goes up by $6,167. Why? Because of revenue. Unearned revenues, which is what Habanero has here, when that's performed, they turn into earned revenues, which we just refer to them as revenue. The account equation balances. So this is both sides of the picture. You're seeing, and this question really helps you understand that a prepaid to one party is a unearned to another party. For here, in this problem, Jalapeno records a prepaid asset, prepaid expense, which is an asset. So I should say, sorry. Prepaid expense, which is the prepaid rent. Habanero, on the flip side, has an unearned revenue because they have to perform on this now. So very interesting. It shows you how important this indirect relationship is between these two items and how exactly to spot what's going on.